Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. With the cash trade just an hour away, here's what you need to know. Asian stocks gain and European futures point higher after a surge in tech drives Wall Street to another record. The Fed's Patrick Harker backs the case for one rate cut later this year. We will get further analysis. European leaders postpone a deal on how to divide the bloc's top jobs. Talks will continue ahead of a summit next week as Ursula Von Der Leyen hopes to win a second term as Commission President. Plus, concerns are growing that France's snap election could jeopardize EU military spending and support for Ukraine. We will speak to Maria Demertzis of Bruegel.
Meanwhile, quick check on the markets. When you're looking at the futures picture, green on the screen by a pretty big margin. Eurostoxx 50 futures up 0.8%. The FTSE 100 right on its heels by up about 0.5%. Some weakness, however, in the European currencies. Euro dollar 107.23. Cable at 126.94. Markets today starts right now.
Tuesday, the 18th of June. Good morning, everybody. Welcome to the program. So, US markets, fresh record highs. I think it's the 30th record that we've hit so far this year. It was led by tech. The real question, I think, this morning is, are investors fearful, and that's why they're buying tech, or are they exuberant, and that's why they're buying tech? It's a hard question to answer at this point as we start to see maybe cracks appearing in some of the macro data. We're going to talk credit later on this program as well and talk about some of the cracks that are maybe appearing there as well. Here in Europe, the situation is dominated by politics and football. Both Macron and Mbappe both getting a bloody nose, and that the effects of both, I think, probably are going to resonate in France this morning as we continue to watch the polling pointing to Macron's party trailing in third. The picture in Brussels as well remains interesting too, who are going to get the top jobs. From a markets point of view, though, this morning, despite the football, despite what's happening with the politics.
I love your efforts to join the football and the politics. I'm convinced that a linking story will present itself firmly. I've seen some, but
I think I've
they're
tried
not compelling enough.
Two bloody noses.
That's good.
Emmanuel Macron. Kylian Mbappe.
I was going to say, do you want to get it out of your system?
We've done the football. We'll move on from the football.
On from the football. So Wall Street, another record high. Upgrades seem to be, the thing of the moment, don't they? We've seen, maybe you talked about this yesterday, guys, but we had just some of the houses, and not the biggest ones perhaps, but Evercore, Main Street Research, I saw both of those upgrading US stocks, and Macron getting an upgrade, and that played a key role in yesterday's rally. Yeah. But it's interesting to see what expectations are baked into those upgrades around the Fed. Are these predicated on Fed rate cuts? They don't seem to be, overly.
No, they don't, which is interesting. It really seems to be a continued story of momentum, of liquidity. Even if you look in the options market, the hedging to the downside, you're pretty cheap when it comes to that picture. I think what's important as well is that if you look at some of even the technical indicators, and I know technical analysis is frowned upon sometimes.
I'm okay with it.
Are you okay? Can you stomach it?
We can talk about it.
We're managing barely. But when you look at it, even all the technical signals are pointing that there should be some sort of caution. You look at the RSI, the Relative Strength Index. You look at the Advanced Decline Line, which, of course, folks at the NICE who look at that tape tick by tick follow. You're seeing real divergences from the S&P 500, and yet no one's batting an eye. And I think that's really interesting.
So I think it is interesting, and I've been thinking about this and trying to work out what's going on. And I keep hearing people talking about tech being defensive.
Yeah.
So every time I see now a headline which talks about a market rally that's been led by tech, I'm wondering, are people just hiding in tech? Are they fearful, so they're buying tech? It's easier and more understandable. Yeah. Therefore, you go to there.
Well, it's interesting. Tech is defensive, and yet if we get more rate cuts, we might also see more of a rally in tech. So tech seems to be playing different things to different people, depending on their narratives. We get retail sales a little bit later on today. That'll be a really interesting take on the US consumer. I was reading Bloomberg Economics saying that consumers are going to be showing themselves to be increasingly under pressure and more reluctant to borrow to spend, which is something that we have seen recently.
Yeah, and I think adding on to that, it's still becoming a capital flow story as well, right? If you start to see this kind of political turmoil really affecting the markets in Europe, do you go to Asia? Do you go to the States? And I feel like it's a very easy, you go to the States and it's a defensive play, which I think brings it back to the fund flow story. But even within that political turmoil, there's plenty to go around. And I think the latest headlines come out of Brussels as opposed to Paris.
They do, but I think Brussels is being influenced by Paris. And I think there's a number of different factors at play here. We'll get a take in just a moment from Berlin. Ollie Crook's going to be joining us. But it feels like we're not there yet. And it does feel like you've got this debate taking place with the EPP at the centre, who are very keen, certainly on Ursula Von Der Leyen continuing. and she looks like she's going to get the nod. But it does seem some of the other jobs, the socialists are making their presence felt. They feel like they're being sidelined at the moment. And it speaks to this increasing tension between the various political groups within Europe. France is just a microcosm of this, but it's writ large across Europe at the moment.
Yes, and the focus is obviously on what happens to Ukraine spending, what happens to military spending, and we'll get some comments from Oliver just in a moment. But I was also with a banker yesterday who was talking about Capital Markets Union, and we've heard so many people talk about the importance of this. I mean, over decades, sure, but recently, even more voices talking about it, and we'll hear from Mario Draghi soon. And you just wonder, how does the rise of the right sit alongside more union? And, you know, maybe that's a bigger conversation which we'll have another day, no doubt. Let's get into the detail of what we heard from Europe over the last 24 hours. Oliver Crook joining us now from Berlin. Oliver, what's the latest then on the deal in terms of who takes which job? We know that they haven't reached any agreement yet.
Yeah, and we can also talk about the Capital Markets Union, my favorite topic, but maybe we'll come back to that a little bit later. So, yeah, this is the sort of meeting, the EU Council meeting, where they were supposed to thrash out the top jobs. And there was actually a lot of optimism going into this that they'd be able to figure this out. However, it's not really the issue of Ursula Von Der Leyen. She is pretty secure in the sort of presidency. Let's have a listen to Mark Rutte and what he had to say going into that meeting.
I think she's an excellent candidate for a next term as Commission President. Obviously, there is also a question of the whole package. That's why tonight I do not expect. Formally, we cannot decide, but also I think in an informal meeting there will be more consensus, is my expectation. So the formal decision next week.
So, guys, the center held, but the center still bickers, and this really comes down to apparently the EU Council job, which is currently held by Charles Michel, and whose actual function it is to shepherd the sort of European leaders into decisions on big issues like this. And he's expected to be replaced by Antonio Costa. But the sort of what they want to do is, rather than do a 5-year term, they want to split it up into 2.5-year terms, with the EPP taking one and the Socialists taking the other. So this is sort of where the sort of tension resides. Where this now goes is into next week, where you have the EU informal leaders meeting on Thursday and Friday. But guys, that is 2 days before the first round of French voting in the legislative election.
Well, Ollie, give us a little bit more insight there. I think Guy at the beginning of the show kind of nodded to it, this connection by the fact that what's going on in Brussels is really a function of what's happening in France. Connect the dots for us a little bit more there, especially in the context of some of the spending issues you're seeing in France.
Yeah, so listen, there are major issues facing Europe. This is not a secret to anybody. And the question with the European Union is getting things done at the best of times when you have leaders that agree is challenging enough. Right now, you have leaders that don't totally see eye to eye, whether that's Macron and Scholz, making things a little bit more difficult. And add to that where you have a sort of internal sort of political strife within France that really could reduce Macron, if he loses the sort of majority here, the election, into basically a lame duck president. And that throws open a whole litany of questions, because there is a lot of questions around what Le Pen's actual agenda is, particularly on, say, defense. I mean, she's been very laudatory in the past of Vladimir Putin, really sort of encouraged closer ties with Russia. She has been more hedged on that on the last couple of years. But they had a pamphlet on defense, the National Rally, that basically advocated France to step out of the NATO command structure. That pamphlet, by the way, came down sometime last week. So, of course, there's still some sort of rearranging of some of the positions, and that creates a huge amount of uncertainty politically and certainly for the markets, and particularly, as Anna was mentioning, at a time when it feels like some of the solutions to Europe's problems are really big sort of European decisions, like something like the Capital Markets Union. What does the sort of Le Pen say about that? I doubt, you know, as a party founded on Euroscepticism, that could go very far.
Ollie, great stuff. Thank you very much indeed. Ollie will keep us up to speed on what is happening as the various pieces of the jigsaw puzzle come together. Let's kind of delve deeper into what is happening with French politics and UK politics. I think there is a connection here once again. We've got a series of parties that are presenting what appear to be hard-to-fathom funding pledges and structural changes to things like pensions that I think the markets are grappling with, because there's just a lack of information. You see this in the socialists in France, very clearly a lot of kind of unfunded pledges in there. What is going to happen with tax? What is going to happen with the pension? Similar story on the right as well. We don't really understand what Le Pen's plans are when it comes to the economy in detail. And then you come to here in the UK, what's happening here. The UK is slightly better in as much as we do have at least some idea of what some of the funding plans will look like. But you look at what Nigel Farage came out with yesterday, really hard to get a handle on exactly what that would mean for the UK economy. And there's so much unfunded stuff in there
Yeah.
that you do wonder how the markets would react.
Yeah, I mean, they're similar in the sense that the right's making a lot of noise in both places, but it's sort of much closer to power in France. Obviously, to your point, Guy, it matters much more what detail is behind Le Pen's ideas. I was drawn to what we heard from Philip Lane, actually, yesterday, sort of linking back to what we've seen in markets. We saw the biggest spread increase on record last week, which we covered a lot here, of course, in terms of French bonds. He was giving us a useful guide. He was saying what we're seeing is repricing, not disorderly market dynamics. That's not to say it couldn't get disorderly, but what we're seeing at the moment is not, in the view of the ECB, it seems, disorderly.
Yeah, and I think it's fascinating because you're talking about it from the sovereign debt perspective. Ian Harnett, I believe, in John Author's column, also pointing out that from a corporate debt perspective, France has more corporate debt relative to its GDP than even the United States does. And that's really a function of the global financial crisis as well. I'm having a little bit of deja vu, though, in the context of the States, because how much of this is stimulative at the end of the day? How much of these kind of spending pledges, if they come to fruition, are similar to the likes of what we saw with Biden for giving student loans, for example, and even that getting in the way of the Fed's kind of hawkish narrative? If the ECB is trying to control inflation or even stay vaguely hawkish, does this get in the way?
I hear what Anna's saying, though, about it does seem that Liz Truss is looming over all of this. That name seems to feature increasingly.
Well, it's interesting that the French themselves...
Liz Truss is not very far.
It's not a big leap, is it?
No.
And the French themselves, Le Maire himself was making that leap, wasn't he? Because he was using it as a warning, although, I did speak to somebody yesterday who was emphasising to me, the different structures behind the gilt market and the OAT market, the different people that hold them, the role of pensions.
Yeah.
Well, there are big differences, and so I suppose we keep calm heads as a result.
Yeah, but there's things that lurk below the surface that we don't know about, which is what happened with the gilt crisis.
Well, we're going to dive into all of that throughout the show. We've got a great lineup, but there's also plenty of economic data that we are watching as well. Here's what's on your agenda today at 10 a.m. UK time. We've got that Euro area CPI. We've got the Germany, I'm going to say ZEW, but I know it's ZEW for the Economic Sentiment Survey. 1:30 p.m. it's that U.S. retail sales number as well. Remember, we're still talking about whether or not this U.S. consumer is still as strong as everyone's kind of expecting it to be. We've got some bond auctions as well on the dock. It's got a 20-year bond auction. What does that mean for demand on the long end of the curve? But I'm curious how much of the monetary policy, the Fed speak, the ECB speak, starts to center around the political story in Europe. Is this something that's mentioned or even referred to in the commentary we're going to hear later today?
Yes, and also it'll be interesting to see how Labour unions react kind of to all this political uncertainty as well. Where do they feature into the landscape? You were pointing out Ige Metall looking for, what is it, 7%?
Yeah. When inflation, and that made that you could see that when inflation was running so far above target that these kind of conversations, you could guess they'd lead to higher wage settlements. You don't know this time because that's a lot higher than inflation.
Yeah, 7%. I think the story that Bloomberg and I believe the FT published as well was that last quarter it was 6.2%. So if you look at the forecast coming out of the Bundesbank, they're actually expecting these wage negotiations to be further inflationary pressure, whereas the ECB is forecasting it in the opposite direction.
The employers are saying zero.
Yeah.
Which probably tells you something about what is happening in terms of the demand story and how they see their businesses growing. They're like, we can't afford to give you a pay rise.
Yeah.
That's the message they're sending.
So do we end up at 3.5? I don't know.
But 3.5 is nearly twice where it should be. I don't know where it should run. I think just north of 2% to get you to a 2% inflation target at the ECB. That 3.5 is.
So and we're going to hear from a lot of ECB officials today.
Yeah. So do you believe the ECB or do you believe the Bundesbank? Do you believe the employers or do you believe the employees? I don't even know how you
it's not belief,
game
it's negotiation. Who do we think is going to win on that one? Let's leave that to one side. 7:13 here in London. Coming up on the programme, concerns are growing that France's snap elections could jeopardise EU military spending and support for Ukraine. As we were hearing from Oliver Crook, those are the conversations that dominate in Brussels and wider, actually, when it comes to the French political story and more broadly. We will hear from Maria Demertzis of Bruegel, get her analysis on France and the broader European story. Plus, Russian President Vladimir Putin will visit North Korea and Vietnam as he faces renewed challenges in his war with Ukraine. We will look at what to expect from the trip, what it means for European geopolitical developments, what it means for war. If you have any questions for our guests, please do get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal to get in touch with us. This is Bloomberg.
Private equity is very smart. What they figured out is it's really costly to put a company in bankruptcy. It's much better to extract a pound of flesh from the creditors. And with 90% of the broadly syndicated loan market being covenant light, they can do that quite efficiently. Coming up with new money solutions from folks like Marathon, who will give the company, the private equity company, additional dollars, right, to make it through, and at the expense of existing creditors.
The View from Marathon Asset Management's Bruce Richards on potentially the dynamics that are showing up in the private capital markets. I want to get a little bit more insight here on this story. Robert Dafforn, CIO for Opportunistic Credit at Polus Capital Management, joins us on set. Robert, a pleasure to have you on the show. Good morning. This was the conversation at Super Return in Berlin about 2 weeks ago, the largest private equity conference in the world, where a lot of people were saying there's so much optimism in this market right now, but it's because some of these deals are getting more and more complex, having more and more covenants, having more and more kind of potential cracks to it, as Jamie Dimon may say, in terms of the private credit space, but only because it's getting more and more complicated. Is this something to worry about?
Well, I think there's lots to worry about, to be quite honest with you. I mean, here we are in a period of very, very tight credit spreads, right? So the markets are, volatility is low. The markets are saying there's probably nothing really to worry about. As a result, what we're seeing is situations, as you saw on that clip, where new money is extended to slightly problematic situations. Now, I think if you take that back to kind of first principles, there aren't that many companies in trouble that need more debt. They usually need less. And I'm old-fashioned enough to believe that actually it really does help if you actually go through a debt reduction exercise in those periods. I think a lot of the situations where we are seeing new money extended to stress and distress situations have a very high ultimate default rate. So, a lot of these things really act as a sticking plaster rather than actually being a genuinely good long-term investment. So, I would be much more cautious on those transactions and much more excited by those where you actually see a genuine debt reduction. If we are in a period where, look, behind the scenes, earnings are pretty sluggish, the private sector globally is not all that robust. So, what I think you need to see in those situations is actually a genuine improvement in solvency and liquidity. Well,
from the beginning of the actual kind of push to in private markets, but even in emerging markets, you argue as well, is the fact that it's really hard to navigate the public markets from a monetary policy standpoint, even from an AI standpoint, now added the politics as well, and the election risk you're seeing on both sides of the Atlantic. I'm curious, though, what the time horizon for that is. If we're talking about this concern around solvency or default even, from a public finance standpoint, in the States, it's January 2025. It's a debt ceiling story. From a corporate standpoint, do you have a timeline? When could we see those cracks become far more visible? The
timeline is it has already begun, and, go for a cliche, gradually then suddenly, right? So you're actually seeing it start to pick up already. I think we see kind of a definite increase in the default rate anyway, right? If it's 3%, we've got a 3% default rate, which is about the medium-term average. 6% if you incorporate distressed exchanges on top. So there are actually a large number of issuers who aren't really able to pay the bills yet. That does tend to accumulate. So for a company in default, you kind of end up defaulting on your supplier, who's now short of cash, and then it does start to slowly ripple through a system. And you end up, it looks a lot like unemployment, right, default rates. Once they start, they're hard to stop. Yeah. So ultimately, it is starting to play out now.
Okay, starting. Yeah. The problem with it is I'm getting 20% on triple Cs. I'm getting really good yields at the moment. If it's away on the horizon, then I'm quite happy to keep taking my 20%. If it's slightly closer, then maybe I want to start getting out of those positions and spreads start sort of widening rather than tightening. Kind of, what do you think the timeline actually looks like?
Well, the first part, that 20% requires that you get your money back at the end.
I totally agree.
Which you might not.
You might not, but you can make that decision further down the road and get your 20%.
Yeah, look, credit becomes very, very illiquid at periods where the default rate picks up. So I would think it's really more likely that the challenge risk that people own now, they probably will own.
So you want to get out now is basically what you're saying.
Absolutely, absolutely. I would also say that, by the way, those headline yields on triple Cs, they really are, it's very bifurcated, right? Sure. Because of the pickup in the default rate and distressed exchanges, there's a meaningful amount of the market trading at really high spreads, 50 or 60 cent on the dollar cash prices. If you're not in the bad house or bad neighborhood of that trading price, you're probably trading pretty close to par, is the truth. So there are actually a lot of very low spread triple Cs out there. So my advice would be go through your portfolio, find out where those live, and maybe get out of those while you can, because it's already begun. The default rate's already started to pick up.
You talked about, well, I'll paraphrase, it sounded like extend and pretend, what you were describing earlier, coming from maybe the private markets instead of the banks. At times of stress, sometimes we call on the banks to do a bit of that, to protect us from default. So maybe there's nothing new in that, perhaps, and the use of this sticking plaster may be not new. And if we're expecting rate cuts to come, then that helps, doesn't it? So what are your rate cut expectations? Because if the sticking plaster only has to hold for a short time, it might do better.
Yeah, well, for sure, the conventional narrative at the moment is you get interest rate cuts on the horizon. That means lower discount rates, higher risk asset prices. But to be quite honest with you, the markets have been expecting that for a really long time already. We had 7 relief rallies in 9 Fed rate hikes, right? That people were expecting it to be the last one. Ultimately, my view is central banks become very data dependent because inflation is sticky. That means rather than being forward-looking in how they set monetary policy, they're going to be slightly backwards-looking in how they set monetary policy. As a result, they'll be cutting when they actually see the sense that an economic slowdown is broadening. And as a result, the rate cuts, I think you're supposed to sell the rate cut, not buy the rate cut, because ultimately it's going to be indicative of the fact that the economy is turning down.
Kriti had a great fact a little bit earlier on. She was talking about the fact that France has a lot of very indebted companies.
Sure.
Are you starting to think about politics? How does politics play into this? You get turbulence in French markets.
Yeah.
Just talk to me about the effect and how you're kind of thinking about, does your portfolio have a French angle to it? How are you thinking about what those political stories could mean? What are you doing?
Well, I mean, it is true that there is a lot of corporate debt in France. It's very similar in the US as well, by the way. But in France, how I would look at it is, we've had some big cap companies struggle, right? Casino, the French retailer, Atos, software business, Altice France, SFR. So, you are seeing ultimately what is playing out there is just not that much earnings growth and too much debt. Is not anything more sinister than that. I think the next phase of it is ultimately, is the French government going to be as financeable, as it has been, and does that ripple through the financial markets? I think government debt to GDP in France rose 3.7% in the fourth quarter to GDP, 3.7 points, which is pretty huge for a single quarter. There's a lot of fiscal financing to get done. I think they need to issue 400 billion of debt over the next 12 months. So, obviously there is a risk there. For us, the two things are, look, perhaps from our short book perspective, we can actually position against things in France that could be asymmetric. But ultimately, when we're restructuring businesses, which is our day job, I think you have to avoid anything that has any regulatory or political input. So, oftentimes when something goes bad, the easy target is the bondholder, the shareholder. And ultimately, if you do have populist politics, you're going to have to steer pretty clear of some of those situations.
Robert, thank you very much for joining us. Robert Dafforn, CIO for Opportunistic Credit at Polus Capital Management. Interesting to talk credit this morning. Coming up, worries over defence and support for Ukraine. They dominate in Brussels. We'll discuss the concerns rippling across Europe amid the political turmoil in France, how that is impacting what goes on in Brussels. We'll get to that conversation shortly. This is Bloomberg. Welcome back to Markets Today. 30 minutes until the start of Tuesday's equity trading session. Here's a look at the markets. Let's have a look for you now at where we are on futures. This is the futures picture. Up by 0.8% on Euro Stoxx 50 futures. So a rebound continues across European stocks. Last week, really weighed down by concerns around France, but perhaps something a little bit different now. We'll bring up the bond market for you as well as we continue to see that same dynamic playing out there. Real sell-off last week. Those spreads widened, but something a little calmer in the last couple of trading days. Interesting to think about where the attitude towards French assets goes from here. I was reading the Taking Stock column, quoting somebody from Silex saying, yeah, we don't feel comfortable around French financial names, around TV channels, motorway concessions, all those names that could be really influenced by government spending and French politics, but saying there could be opportunities in French stocks more broadly, those with international exposure, luxury goods, consumer goods, electrical components. These are a lot of the reasons why people buy French stocks in the first place.
I think Jeffrey's upgraded Schneider this morning, so maybe that's some evidence of that. Schneider Electric, yeah. Clearly there are going to be good companies and bad companies. Clearly there are going to be companies that are affected by the politics and not affected by the politics. The question is, at what point are you prepared to make that decision that you are going to step in, given the uncertainty around the politics at the moment and the polling? Really difficult to know exactly what's going to happen. What would happen if you were to get a Liz Truss moment? What would happen broadly to financing of these businesses in France? Yes, their end markets are kind of over there, but maybe their financing requirements are over here. And it's difficult to get into the... It's difficult to fully understand yet what is happening here. So it's interesting that the stocks bounced yesterday. You kind of understand the buy the dip mentality. How much longer does that continue? And is today's bounce, this morning's bounce, driven by the US, or a belief that actually Europe has more traction here?
You mentioned the luxury sector. For me, it's the banking sector. And maybe this is where you guys can educate me a little bit. I'm confused about what moves the banking sector, specifically because off the back of this, your SocGens, your credit agricoles were your biggest hit stocks in terms of the political turmoil of last week, where you saw the 5% correction in the broader index. But put that in the context of an ECB that's still expected to cut, weakness still on the continent. Doesn't that pressure your net interest income, for example? So doesn't that just create this almost counterweight to any sort of buy the dip mentality you have around that sector specifically?
Yeah, I think the point that Anna was making is that this group in particular was nervous about French banks and is likely to remain so. The exposure to the sovereign is so significant that any big move, any nervousness around what happens with the OATs goes straight back into the banking sector.
That's one thing that links us back to 2011, isn't it? I mean, there are many differences and there are many reasons not to over-exaggerate. Marcus Ashworth has a nice piece out saying, this isn't Frexit, this is not on the cards, so let's not make out like it's more like 2011 than it really is. Interesting to also think, you were talking about how, yes, their business is international, but their financing needs are domestic, and that's an interesting one because I was looking at, how much of the CAC 40 really reflects France. The financing
like the FTSE 100,
but it's like the FTSE 100. We have this conversation often in a UK context. So analysts pointing out at Morgan Stanley, about 15% of the CAC 40 and the MSCI France index have direct domestic links. That's not a big number, is it? But to your point, the financing does get influenced by OATs.
You just don't know how. It's the unknown connections, which is what the gilt crisis taught us, is that you don't fully understand what's going on below the surface until you actually start to see it emerging. And if you were to get a crisis in the French bond market, which is very different to the gilt market, you've already pointed that out, but there could be there are unknown unknowns lurking, and I think the market just is definitely in sort of shoot first, ask questions later kind of mode at the moment, and probably will remain so until some more clarity emerges.
And I think it comes right back to that keyword, until the clarity emerges. And I think that's why you're seeing this fund flow go back into the States as well. And I keep talking about the technicals, and the reason I do it is Abigail Doolittle, our colleague over in the States, brought up a chart overnight that I thought was really interesting, where she was pointing out, and hopefully our producers can bring it up on the screen, but really showing that the S&P 500 is diverging from this thing called the NYSE advanced decline line. So basically more stocks going up versus stocks going down. And that's the line you're seeing in white behind me here, really showing that more stocks are dropping than increasing in terms of simply the number of stocks, whereas the actual S&P 500, as a function of that tech weighting, is increasing.
Doesn't that make perfect sense, though, when you think about what is happening with the tech stocks?
Yeah, exactly. This is a question of breadth.
The market is high. The market, and this is why I can't figure out why, if people are buying tech, are they nervous or are they exuberant? Do they feel that the AI story is going to be fantastic and therefore they buy tech, or are they buying it because these are at least understandable businesses with some growth potential that is maybe disconnected to the wider growth story? It's really hard to tell at this stage.
As we see tech stocks do so well, as we see US stocks take out new highs, it's interesting to think about the earnings stories and where they take us, because every time we talk to stock analysts, they tell us something quite positive, I feel, about where the earnings story is. And interesting to talk to Robert last hour, just 10 minutes ago, in the last half hour. And he was telling a slightly more negative story around corporate balance sheets, wasn't he? He was suggesting that things aren't quite so rosy. I mean, maybe he spends too much time with the lower valued stuff. But that's an interesting different take on corporate
credit people.
health.
Credit people tend to be more downbeat, glass half empty. Equity people tend to be more glass half full.
All the more cliche in there.
All the more reason, right? Isn't this the deja vu, FOMO and Tina? There is no alternative. Your fear of missing out. Isn't that what this exuberance really is? It's exuberance around AI, but it's also where else is there to go? Isn't that kind of the narrative?
And that's the problem.
Right, yeah. A lot of what we've been discussing this morning then around uncertainty around France, where the policy direction goes. Firstly, who's going to form the next government, and then where the policy direction goes from there. How fundable is France still, in the words of our credit guest in the last half hour. Let's talk about that. Concerns are growing that France's snap elections could jeopardise EU military spending and support for Ukraine. The far-right National Rally continues to lead opinion polls in France ahead of that vote, with Emmanuel Macron's Renaissance Party and its allies currently in third place. For more on the political upheaval in France and how it's spilling out into the rest of Europe, let's talk to Maria Demertzis, who's Senior Fellow at Bruegel. Maria, thank you so much for joining us. Let's start with the French situation, shall we? We have a lot of uncertainty, a lot of policy uncertainty around what a parliament dominated or led by Le Pen and the National Rally, what that would look like. Do you have any insights around their spending plans, around their fiscal plans that are coming to light over the last 24 hours or so that we need to be aware of?
Indeed, the program that the National Rally has actually won the elections on is one of great spending. They are there to finance companies that are doing well. They are supposed to give subsidies everywhere. So, in fact, economically speaking, they're very much on the left of policies. And this is indeed very worrying because France has got already a very high debt, about 110%. More than that is what France has currently as a debt ratio. And in fact, when the new fiscal rules kick in as from September on, the European Commission is expecting France to consolidate between 0.5 percentage point and 1 percentage point every year for the next 4 years. So indeed, the European Commission will be advising France to actually cut spending. But the promise of the National Rally is actually to spend, and that's not good news at all.
OK, so that's the fiscal side. That's broadly where they come from, Maria. And we'll wait to see if we get more details on what that would look like if we had a cohabitation situation, I suppose. What about on defence policy, membership of NATO? It's quite common for some populist parties to be quite anti-NATO, and our colleague was telling us earlier that that is the case in this situation. What do we need to know about their sort of foreign policy outlook?
I think the news is less troubling in my view, and that happens because, assuming we have cohabitation, the split of the files will be such that defence and foreign policy will still remain with the president. So if we have a cohabitation and President Macron remains the president, he will be the one in charge of foreign policy military spending, whereas the prime minister, the new prime minister, expected to be, of course, from the winning party, will be more in charge of domestic policy. So in that regard, I think foreign policy and defence will remain very much as in the current course. And of course, France's position in the EU will also be the same.
Maria, good morning. What if we don't get a winning party? What if we end up with a sort of chaotic situation where nobody quite gets enough to deliver what they want, and we see a whole series of deals having to be done on an ongoing basis to get policy through? How will France progress in that kind of environment? What kind of policy do you think will emerge from a situation where nobody gets enough, nobody wins enough in the second round to actually do anything to form a government?
Well, I'm sure there will be some governing solution. And remember, this is prime ministerial elections, it's not presidential elections. In the context of France, given their system, it is the presidential election that's most important one. And this is not what is happening in a few days. We're having a prime ministerial election. And therefore, it's very unlikely that we will see an outcome which is not stable. There will be an outcome, and the winning party will deliver the prime minister. And I think that will happen. So I think that scenario of chaos is very unlikely in the context of the next election.
What happens if the left win? And what do you think of their policies in terms of their spending? You don't think that's likely?
They're very similar, actually. They're very similar to the extreme right policies. When it comes to economics, this is, of course, a paradox. That the far right is not one single story. In France, the far right has got very left-leaning economic policies, where in Germany it does not. And that, of course, makes things a lot more complicated. So in that respect, the far right and the far left, when it comes to economics alone, are actually very similar.
Maria, it's Kriti in London. Can you give perhaps a little bit more color for our international audience around the concerns around the retirement age in particular? First, perhaps moving it up, or at least trying to, from Macron's government to 63 or 64, and then potentially this threat from the left to move it right back down to 60. How does that play out? What likelihood is it that it moves in either direction?
Well, we've already had this in France with President Macron is trying to change the pension age in France. That was, as you may remember, extremely difficult. I don't think this is the first thing that a potential new right-wing government, extreme right government, is going to attempt, because already we've seen that it has been extremely difficult to happen. On top of that, I would remind you that there is a lot of pressure coming from Brussels, from the EU on France, given the fiscal position, which of course requires the extension age of pension, to the increase of the pension age. So in my view, this will not be the first economic policy that is being attempted by any new government.
Well, to your point about that pressure around the fiscal position and the debt position, is a gridlock then perhaps the best case scenario in terms of just maintaining the French financial safety and security? Your take?
I don't think so. We need good outcomes. And by good outcomes at this point, I mean clear outcomes, because the more muddled the politics get, I think the markets are going to be looking very closely. Already we've seen a surge in the markets, as you've explained earlier on. And I think that we need some clarity in terms of who will govern which files and to what term. So a gridlock right now would not be a good outcome.
And how is this influencing European politics, Maria? We've seen on display overnight in Brussels a failure to reach agreement on who becomes or who stays, if it is the case of Ursula von der Leyen, in charge at the European level. Are you expecting continuity, even if it takes some time to get there?
I think that paradoxically we are in a position where what is going on right now in terms of deciding the new positions in Brussels is the easiest it had ever been. And we've seen this from a number of prime ministers who came out yesterday and said, look, we'll get there. It's normal what is going on right now in Brussels. This is the first time they meet about this position. I think we will probably have clarity by the end of June in terms of at least who will be the next president of the European Commission, I mean of Mrs. Von der Leyen. So in that respect, I think what we're hearing right now is not different to what we've seen other years. If anything, and that's why it's paradoxical, I think we will get to a decision much faster than any other time.
All right, Maria Demertzis, Senior Fellow at Bruegel, we thank you so much for joining us this morning. Coming up on the program, we're going to get to your stocks to watch ahead of the European market open, including education publisher Pearson. Comes after U.S. education tech firm Chegg soared in after-hours trading following an announcement related to an AI push. We're going to dive into the details later. And on top of that, stocks to watch, we've also got a great interview later in the U.S. session. Sonali Basak speaking exclusively with Citigroup's CFO Mark Mason. You do not want to miss that in the context of the massive protests around that bank in New York. That conversation, 7:15 p.m. London time. This is Bloomberg.
Welcome back to Markets Today, 7:47 here in London. So 13 minutes until the start of an equity session that looks as if it could be positive. Another day of bouncing following the sell-off in French assets in particular that we saw last week. So we do expect to recoup some of those losses, not all of them by any stretch. Continue to focus on those French banks, French motorway businesses, for example, being mentioned by some. Really interesting to think about where the macro picture goes from here. We've had comments from Patrick Harker saying one cut's appropriate, but he did say two or none are still possible. I mean, maybe this is the detail of monetary policy we shouldn't dwell on.
There is no news in this whatsoever. The Fed's kind of got one on the books now, possibly two. I think he's just sort of replicating what the dots are selling us.
Yeah, and he's not a voting member, right?
No.
So this is kind of a shrug on the shoulders. But I thought what he said, the one piece I thought was kind of interesting, besides saying that he's going to remain data dependent, surprise, surprise. He also says that the rates are high enough to keep reducing inflation, even though progress has been uneven. And I think the recognition of the fact that progress has been uneven is best seen in the U.S. housing market. And this is my favorite kind of fun fact, because you see these kind of easing price pressures in certain cities in the States, Seattle, for example, Austin, for example, some of the big places that really saw this massive growth post-COVID, but it's declining far more than still your major urban cities, Chicago, New York, LA, of course, where things are still actually rising. It is insane when you look at the housing divide.
Yeah, so there's the housing story and inflation around that to focus on. He broadly wants to see several months of data moving in the right direction. So
again, pretty consistent with what we've been hearing.
Yeah. Yes, but it gives us a sense of the timing. You know, we're still several months away from movement.
Yeah, and go ahead.
Well, I was going to say, back to your point about what's happening with housing, though. The Journal's leading with this morning and basically saying that the rental story is now bottoming out. We've seen disinflation in rentals, to your point about what is happening in some of these key urban areas. That is now bottoming out, and you could expect a pickup. So the disinflationary effect you've had in terms of the rental story into the inflation data is now running out of steam.
Well, this is something that goes global as well, and I'm kind of the queen of charts today because I've got another one. I was leading you into it, guys, setting up the stage, because there's a chart on this coming out of not the States but in China. We're looking at new home prices, and I thought this was really interesting because when we talk about this disinflationary narrative, we think about China, right? Are they exporting deflation to the rest of the world? This chart, I think, shows it quite well, which talks about those new home prices. And you can see it's still declining pretty substantially, going all the way back. I can't actually see that far, but going all the way back to a while.
You can't see that far,
I was about to say.
We're struggling.
I was about to say, but you can see that it's not a positive trend. You can still see new home prices are actually declining. And although that, in theory, on a month-over-month basis should be a good thing, perhaps it's not in the context of how resilient is growth.
OK, let's talk about the global inflation narrative. Joining us now, Ben Ram from our Markets Live team to talk about the markets in 2 minutes. Ben, let's see if we get any clues from Australia. And I mentioned this because we've had a rate decision from the RBA. No change so far, so simple. But interesting that they're talking about inflation proving persistent, amping up the language there. The case for a rate cut was not even considered, and the market is concerned about rate hikes in the future in Australia. What do we learn from the Australian example?
Well, at the start of the year, Anna, the markets were thinking we would get 3 rate cuts from Australia. But 6 months into the year, what is transpiring is that forget a rate cut. They're thinking about a rate hike. And the governor, RBA governor, said as much in a press conference this morning. And if you look at the RBA statement, it's extremely hawkish. It says they reintroduce the language saying that they will do whatever it takes to contain inflation. That looks like that is very reminiscent of what the ECB has been saying of late. And it also ties into the big picture here, Anna, which is that of higher neutral rates that we are in. If you look at the Fed's neutral rate, last week, they raised the neutral rate estimate to 280. Just months ago, it was at 250. So 30 basis points we have done in the space of just 2 months. It's not every day that the Fed raises the neutral rate. So that says something about this expansion, the strength of this economic cycle. And investors should therefore be assuming that rates are going to be higher for longer, which is why I think that the market's pricing of 2 rate cuts from the Fed this year looks a bit overstated to me.
OK. And then if we don't get those cuts, and there's different views out there as to how many we do get, if any, what does that do to stocks? Stocks have been so resilient as we've priced out rate cuts this year. Well,
stocks are in a case of heads I win, tails you lose kind of situation. No matter what the Fed has been doing with rates, stocks have been going up. And, that is obviously due to the enthusiasm surrounding artificial intelligence and the prospect of it to boost productivity. Now, I ran some numbers, and what it shows is that if you assume Nasdaq as a long-duration bond, discount the future cash flows, and bring it to today, it shows that the fair value is around 13,000. So we are vastly in a bubble at this moment.
Ben, thank you so much. Thanks for your time. Ben Ram from our Markets Live team. You can get analysis and insight from the Markets Live team. MLIV Go is the function if you want to hear from Ben, Mark Cudmore and the rest of the Markets Live group blogging on there for you. Let's get a look at the stocks in focus this morning here in Europe. Joe Easton has a briefing. Joe.
Morning, Anna. So we're starting with one stock that's really showing the impact of AI on the education space, with California-based Chegg in the US soaring 20% last night as they announced that they will trim their workforce by as much as 23% and build a new AI platform instead to host a lot of its publications. Now, we've got a good quote from Jefferies here on the screen saying that this company is under duress from AI because of the competitive threat that is happening on the business, and therefore that is the reason they need to make up some ground. We did see a bit of weakness in Pearson in London, which is a competitor last year during the AI boom, so that could be one to watch as a potential read across. Then we're over in pharma. The Bloomberg Deals team added again with an exclusive on Recordati. This is a maker of cardiovascular illness drugs, and the Deals team saying that they've got private equity interest. They're coming from a couple of firms that we haven't quite got on the screen there, but they're coming from a couple of firms, including TPG. There we go on the screen. TPG and KKR looking to potentially buy some of CVC stake. Could be a gainer this morning. Finally, Whitbread seeing some weakness in UK hotel sales today, reporting a 1% decline in quarterly UK sales. Interestingly, though, they point to strong breakfast sales. Everyone buying their fry-ups in the UK hotels. A bit of strength in Germany as well. Maybe that's some football fans in Europe. Keep an eye on Whitbread in London this morning.
Great stuff, Joe. Thank you very much indeed. Joe Easton joining us on which stocks we want to be watching at the European Open. Broadly, I think you're going to see a bid. That certainly seems the narrative coming out of the futures picture at the moment. Looks like we are going to be seeing European stocks going higher once again. You're probably you are seeing a bid in the bond market as well this morning. A cautious one, but nevertheless, there is a bid. The market open is next. We've got it all covered. This is Bloomberg. Tuesday the 18th, a couple of minutes to go until the start of equity trading here in Europe this morning. Yesterday's session, initial bid fades. Markets basically trade sideways here in Europe, equity markets throughout the afternoon session. The US picture looks a little bit different. The afternoon, we get a bid in the market. It fades a little bit as we come through into the close. But nevertheless, there's forward momentum in the US markets. That is what we are about to price in here in Europe this morning. What happens to the rest of the session? Who knows? But certainly the narrative out of the States is fresh record highs, and that's likely to propel Europe a little higher this morning.
Yeah, and that seems as if it has something to teach Europe, doesn't it? Because yesterday's session was pretty divided between those sectors in negative territory, those in positive territory, and then the US story took over, and we saw what happened to some of those tech names. Travel and leisure and banks did well yesterday, but interestingly, not necessarily a rebound in French banks. A bank, just the sector as a whole, was recouping some of its losses, but we didn't see the French banks to the fore.
No, we didn't. We also didn't see a bid into the commodity sector, and I keep waiting for that to happen because traditionally when you look at the FTSE, at least in the last couple of months, I want to say, you have seen the likes of Rio Tinto, for example, Glencore, actually lead a lot of it. And now I think a big part of that is simply what we're seeing in the macro space, the fact that we're seeing Brent crude kind of trade sideways. But an 84 handle on Brent, it's still a positive story when it comes to
higher than the end of last week.
Exactly.
Yeah.
And yet it doesn't feel like the stocks are really catching up.
Look what caused deflation in the last CPI print we got out of the States. Oil was a big component, gas prices were a big component, and they are maybe starting to tick higher again. So it's going to be interesting to see whether that, plus the rents, is another factor you need to fold into the CPI story over in the US.
European equity markets then just about to open up, just 10 seconds or so until the start of the European equity trading day. We are expecting to see that rebound in Europe then continuing. We saw some of it yesterday. We expect another day of that as we price in the strength that we saw on Wall Street. Record highs over on Wall Street from the likes of Tesla and Apple on the rise. So we'll see what that does to European stocks. The FTSE 100 opened then up by 0.2%, so modest gains at the start of the trading day. How long, to Guy's point, does this continue for the rest of the day when we get the US back in play? We'll see. Of course, there's a public, there's a public holiday tomorrow, isn't
there?
Tomorrow,
15th,
not today, so tomorrow. But that, can influence the volumes that we see. US futures pretty flat to positive, as we see European stocks opening higher as expected, up 0.6% on the stock 600.
So you guys are making the point earlier on about the fact that French stocks, many of them just have exposure to the rest of the world, and they are global businesses, and therefore maybe these are the kind of the babies that are being thrown out with the bathwater right now. You look at the list of stocks that are doing well in terms of the points gain we're getting in Europe this morning. Schneider Electric does have an upgrade, but it's up by over 2% this morning. LVMH is the third best performing points gainer out of Europe this morning. Airbus is up really quite nicely as well. It continues to move higher. Vinci is bouncing back as well. Maybe it's a more sort of domestic exposed stock, but nevertheless, so some of these big heavyweight French stocks are coming back this morning, and it's those with a more international flavour that maybe are seeing the best of the gains.
One of the stocks thinking about what's going higher this morning, one of the stocks that Joe was mentioning, Whitbread, also doing pretty well. That on the back of the earnings story we got out from them. There's probably a football connection there. As he was pointing us in that direction. But certainly that is a travel and leisure stock that's not doing too badly. The second day that we see travel and leisure at the top of the gainers board in terms of sectors.
Yeah, and I'll add to Guy's thing about the French stocks as well. BNP as well doing quite well. So you're seeing some of the banks catch up in addition to some of the other moves as well.
Yeah.
However, in the UK, you're seeing some of the commodity names start to show up, and even British banks as well in your top 10.
The one stock that is slightly making me kind of pause for a moment is Carrefour. Carrefour is being absolutely smashed this morning.
Oh, yeah.
The stock is down by over 8.8%. I've just gone to my dev screen. I can't see that it's gone ex-dividend or anything, but that stock is down very heavily at the Paris Open and is certainly easily at the bottom of the CAC and easily at the bottom of the Stock 600. So some significant losses coming out of the French grocery sector. Is that a debt story? Is that a consumer story? I don't know. We'll dig into that and find out a little bit more detail.
Yeah,
we'll check it out.
Yeah, absolutely. all I can say right now, dropping more than 6% to the lowest in 3 years. Volume really surging. But yeah, to your point, there's not a very clear reason as to why. We'll continue to probe into that one. Joe Easton, I'm sure, will be all over that story.
And I think L'Oreal as well is also under some pressure as well. Is there a connection between makeup and food? Do you shop for your makeup and food together, Guy?
Let's not go
always. I don't know. The L'Oreal drop is kind of is significant in as much as it stands out that that is a business with an international story as well, but is on the downside, whereas stocks like LVMH are on the upside. But the Carrefour numbers. I want to go back and just take a look at the GIP, the session chart, and just see where we're sitting now. We're down by 7%, so it stands out as a significant French loser this morning.
Yeah.
Can't figure out why. Is it a political story? Maybe.
Yeah, well, that's something that we're going to be keeping an eye on in terms of what kind of rebound you see in French stocks and in terms of the broader European story as well. We actually asked this to our guest yesterday, Michael Metcalf over at State Street. We basically said, what do you need to see to actually be more confident in a rebound that really reverses some of the pain that we've seen in the European markets? Take a listen to what he had to say.
Going into this, investors were neutrally positioned on Eurozone equities as a whole. Now, interestingly, they were already quite underweight the euro. So you know, what I would look for actually is for the euro to stabilise first, because I think that's where investors were ready for some bad European news, and then maybe the equity market will follow. While investors have been very reluctant to buy the euro, they have squared their underweight in sterling, and they've continued to square that underweight, even though you've had the earlier election announcement.
So that's the take out of State Street. Let's get another take out of TKO. Raphael Touan, head of capital market strategies at TKO Capital, joins us this morning. A pleasure to have you on set. From your perspective, what does it take to reverse the carnage of last week?
I mean, let's see a bit what we're talking about in terms of price move. It has been significant, and we can argue that obviously this episode will leave a trace somewhat in the market history. It's not a massive sell-off. We're not at distress levels. We're seeing indeed through stocks the CAC 40 losing a little bit of steam, but basically it's flat for the year, so nothing dramatic here. And the market was probably due to a pause, for some kind of breathing. So nothing too dramatic in terms of stocks. When you look at credit and French credit, you've seen some underperformance, but no massive spread widening when it comes to French-specific credit risk. And it's true that the one area for contagion is interest rates. We've seen a widening of the gap between the German and the French rate, for instance, indeed. We're talking about 30 bips wider. So when you compare to history, when you compare with what happened in the UK, for instance, during the mini-budget, when you compare to Italy, there is no massive distress in the market yet. So, I guess the market is waiting to see. Very lack of clarity, obviously, very high uncertainty. For one, we can say uncertainty without misusing the word. You don't know about what's going to happen in terms of election. You don't really know about the economic agenda of each party. And you don't even know, obviously, how the market is going to react. So a lot of uncertainty, not so much of a big discount in the market. So I guess it's a wait-and-see mode prevails.
So what is the best-case scenario here, even with the lack of clarity, which we may not get for some time? What is the best-case scenario in terms of political risk in France when it comes to the markets?
So the first thing the investors are going to look forward is more clarity, and this maybe might come ahead of the election day, starting to understand a little bit about the economic agenda, really the key thematic behind being the deficits. We know that this is front and center, especially in France. France came into this episode with a weak positioning towards its deficit. It's the second largest deficit in the Eurozone, only second of Slovakia. It's one of the highest ratio debt over GDP at 110%. Remember that 2 weeks ago, S&P downgraded its rating. So the narrative was pretty harsh on France before the election, and is getting even worse. So the key question now is what's going to happen to the deficits? What about those economic agendas ahead? Are they going to be orthodox enough to maintain a reasonable trajectory for deficits? And also, last question, very tough to answer, to what extent the market is willing and capable of absorbing more deficit, absorbing more debt.
OK, so do they say orthodox enough is an interesting way to phrase it, Raphael. We spoke to a guest in the last hour of the programme who was saying that if you look at National Rally or if you look at the far left proposition, actually in the French context, they're quite similar in terms of fiscal spending, in terms of what that does to the deficit story. And given that those two parties are polling, you know, number one and number two, or two groupings in the case of the left are polling numbers 1 and 2 in the poll of polls in France, do you think that that is priced in? Have we priced in a leftist fiscal policy in France, or is that still to come?
So one could argue that we haven't priced in a massive gap in deficits. That's for sure. When you look at what interest rates have been doing, by the way, they are basically flat in absolute terms. We're looking at the gap, rightfully so, versus Germany. We are looking at the gap versus Portugal. By the way, Portugal 10-year and French 10-year are trading in line now. So yes, this gap has evolved, but absolute level of interest rate is rather flat. And it's true that if we were to imagine a political and economical agenda with a gap in the deficits and really heavy spending, we could imagine some impact on interest rates. One way to look at it, and one way at TKO we've been advocating a lot, is a steepening of the curve. We could argue that potentially 2-year is right where it should be, but the 10-year is very low. And in the case of massive deficit agenda, there could be potentially some upside risk over the long-term rates. Haven't seen that yet. So clearly the market has not priced in totally this kind of scenario, and maybe rightfully so too. First of all, uncertainty, what's going to happen. Second of all, you could also imagine, as we saw in Italy previously, that, you know, political parties will fine-tune a little bit their economic agenda. Some of the initial measures are being pushed to a bit further down the road. We don't know when. Yeah. And we could imagine too that politicians are watching the markets and trying to gauge to what extent they could push with their agenda without triggering something else.
And Raphael, does cohabitation between whoever leads the parliament and Emmanuel Macron as president, does that take the edge off? Does that lead to something more orthodox? Or do they just operate in different policy areas and so actually no?
It's a good question. When you look back in history, remember for the US, the market was very pleased with kind of a stall agenda so that, you know, business could hum and continue to thrive with no massive shift on the right or on the left. One could imagine and one could say that right now the markets are fairly happy with the way things are in France, you know, and they've somewhat benefited from more recent policies. So very difficult to predict, but past in history, you could say that a stalled political agenda was pretty well received by markets.
Why should I invest in Europe right now? Why don't I just put all my money in the States?
Well, this is a question we are hearing a lot. So indeed, Europe, when you think of it, it's high uncertainty now. When you look at growth prospects, although you can argue Europe is rebounding when the US is slowing down, you still have quite a gap. Interestingly, at TKO, we're taking the opposite view. I feel it's a great day to invest in Europe. When you look at the European landscape as it is, positioning is very light. Nobody wants to be invested in Europe. Everybody's underweight Europe. Sentiment is awful. Look at the elections, the growth prospect, the way, you know, war in Ukraine. So very poor sentiment. You can argue, obviously, that valuations are the cheapest in history compared to the US, so the valuation gap is massive. And looking forward, once again, looking at the direction of the wind, the direction of indicators, Europe will be on the rebound. When you look at projections for economic growth, consensus is expecting Europe to rebound and start growing again in 2025, 2026, as opposed to what you're seeing in the US, where we have a slowdown. So you have an interesting mix, doesn't come without risk, doesn't come without volatility. There are good reasons for this discount, but weak positioning, weak sentiment, good growth prospect, and very cheap valuation makes up for a good mix for investment. And I would add to that one additional layer, and this will go a bit in contrary with what we are seeing with the elections. Europe is also trying to emerge as a strong power again.
Can it do... all of those things are great, but can it do those? Can Europe deliver, given the political uncertainty? Like, it wants to emerge as a stronger power. It wants to have a capital markets union. It wants to have a stronger defence sector. You've got a weak German government. You've got a very weak French government. Those are the two driving forces in Europe. If they are not firing, are you really going to see a Europe emerging with that strength that you're talking about?
This is a setback, but it's probably a bump in the road in our view. There is something bigger behind the scene brewing. We call it a mega trend at TKO, and that's something we're investing in massively right now. It's the rise of European sovereignty. This idea that Europe is now deploying massive amounts of capital, both public and private, to retool, to rearm, literally also itself, in defense. 80% of the European defense budget is spent outside of Europe. European champions will benefit from the rise in defense spending. Pharma, 80% of the pharmaceutical molecules used in the pharma industry in Europe are coming from outside Europe. Infrastructure, energy transition, there are massive public spending being discussed and agreed on to reboost Europe on those strategic sectors. And we feel this is probably a mega trend in the making, so we wouldn't bet against Europe.
Raphael, great to see you. Thanks for stopping by. It's an interesting angle. A lot of people are very cautious. Nice to hear a more positive spin being put on what is happening here. Raphael Thuin, Head of Capital Market Strategies at TKO Capital. Thank you very much indeed. Quick look at the Core 6, just to see what's happening here. Some of the French stocks certainly have been coming back reasonably strongly, but beginning to fade now. As you can see, LVMH is now down in negative territory. Schneider, though, with an upgrade this morning, looking a little bit more positive. The French stock that I really want to know about, though, is what is happening with Carrefour. Definitely in the discount bin this morning. Marked down quite sharply. What is it, down 9%, Joe?
So it's ticking lower as I speak, Guy. Now down 9.6%. We're heading down towards a 10% drop. Now, that was the biggest decline in 4 years when I was at my terminal a moment ago. Now, every trader I speak to is pointing to an article in La Lettre over in France, and it is discussing the economy minister potentially looking to impose a fine on Carrefour related to how they conduct their franchise business. Now, I must note that we haven't yet gotten a response from the company, but that is what's driving the shares lower. So we'll wait to see how Carrefour respond to that. But it is in La Lettre, the newspaper. Now, I would keep an eye on that stock. As I say, we're down 9.3% on that stock, really the worst performer we've got today. Then we'll look at the education stocks. We mentioned that huge surge for Chegg last night in the US, 20%. They're cutting around a fifth of their workforce and replacing it with a potential AI platform, seeing a bit of feed through into the European-focused education companies, the European-listed ones. Pearson getting a bit of a gain. Bloomsbury in London down in the small caps, and Sonoma over in Helsinki as well. Some smaller bits of green on the screen for that one. Then in terms of the earnings, there were a few out and there was a couple weakening on the screen. Well, first we'll start with Whitbread. Try to get the football reference in with the Euros. German sales up 5%. Potentially it's all the football fans out there celebrating. That one gaining today, the Premier Inn owner. Ashtead, though, coming down. Now the company released some sales looking slightly weak in the North American construction business, which is where they do most of their work. And there is no mention of a relisting away from London to New York, which has been speculated a lot recently, so potentially some disappointment there. Brought up Comax. This is a industrial company out of Switzerland. We might not actually be trading on that one yet, suggesting there could be some weakness. I've seen some Sharp calls lower on that one today. It's an industrial components firm. Over in pharma, though, Recordati will take a check on that one. Takeover interest from private equity looking at its stake held by CVC. We're up 1.9% in that one. They're not looking to pay a huge premium, according to the report, but we are seeing some small gains in that one. One stock absolutely hammered today in London, XP Power. Take a look at this one. We're down 23%. We were at the open. It's come up a bit now, down 19%. It was in a trading halt earlier as well. Now, this is a components maker in the energy business, make conversions for electric businesses. A takeover deal has collapsed for this company. It's listed in London, but based in Singapore, really getting slammed today. Finally, one morning call to bring you is ST Micro losing its last sell rating this morning, and that one was ticking a bit higher, up 1.8%. Now, Goldman Sachs goes neutral from negative. They say that potentially we've seen the trough in chips that go into autos, industrial components, PC, smartphones, that kind of thing. They're calling the bottom of the market and no longer a single sell on that stock. And we're gaining 1.9% for ST Micro this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through those stocks moving in the early market, or early open, I should say. Coming up on the program, worries over defense and support for Ukraine. We're going to dive into the concern rippling across Europe amid the political turmoil in France. We dig further into the story. Stick with us. This is Bloomberg.
Welcome back. This is Markets Today, 8:20 here in London, over in Paris, 9:20, and European equity markets. Actually, not much difference between them in terms of where we are on the French market, up by 0.5%. The overall stock 600 up by around 0.6%. So France does not stand out today as an outperformer or underperformer, and last week underperformance certainly was the thing. Let's return to the subject of France and President Macron's surprise snap election. With the far-right National Rally continuing to lead in the opinion polls, many are asking what the rise of populism means and trying to draw conclusions as to where this leads the market. Even the finance minister in France has drawn parallels between the Liz Truss era in the UK and what we're seeing in France right now. Let's bring in the author of one Bloomberg opinion piece, Lionel Laurent, who joins us from Bloomberg Opinion. So the subject of this snap vote then, and that's triggered a lot of people to look at what's happening with Le Pen's party and to think back to what happened under Liz Truss in the UK, Lionel. Tell us about where that comparison is relevant, because a lot of people say, no, hang on, there's a lot of structures in the gilt market in the UK that exaggerated that move, and that doesn't exist in France.
That's correct, and I don't think we are going to see a kind of Euro crisis or a technical sudden panic on markets. I think the similarity, though, is with the potential for a budget mess, a kind of over-ambition in terms of fiscal spending, and the resistance of the market. There is an expression in French, wall of money. It's been around for 100 years, and it was around even in the 1980s when the original Liz Truss, François Mitterrand, socialist president, tried to completely reshape the economy and was totally rejected by the market. So the market is going to be a player in this election, even if we don't see some kind of Euro crisis on the cards.
How sensitive do you think politicians are in France as a result of what we've seen with the UK and Liz Truss? Is that a lesson that was learnt in France? Do you think it was learnt on the left? Do you think it was learnt on the right? And do you think it is already influencing policy?
So I think for Macron, he's obviously been watching Brexit very closely over the years and used that as a stick with which to hit Marine Le Pen, who herself has become a lot less anti-EU over the years. I think the thing is, though, that voters haven't followed really what's happened in the UK. I think, to your point, politicians will tread carefully, but I think basically you're looking at a race between Le Pen's party, which is trying to prove that it can govern, so it will not put a foot wrong at all and do everything it can to appear normal, and the far left, which wants to be the party of opposition. So it's going to promise lots and lots and lots of economic unicorns in the knowledge that it won't have to actually deliver them.
Lionel, we just had the chief capital market strategist over at TKO talking about the fact that historically, sometimes markets on both sides of the Atlantic favor gridlock. I'm curious, in your opinion, if gridlock is the best case scenario here.
It is in the short term. That's why I think markets have calmed down, and it's why I think that if you do get the expected scenario, markets could well rally. But that's in the short term. I think over the next few years, the concern is of a kind of corrosion, entanglements in the civil service, a real attempt to change the way the French state operates, and then presidential elections in 2027. French politics is winner takes all. That's what Le Pen has her eye on. If she is president as well as having control of the government, that could be a huge change in French politics in the medium term and the economy.
Taking a step back, Lionel, and looking at what has driven us to this point, do you look back at the bout of inflation that has passed through many Western economies and say, you know, it must be a story as old as time, that kind of inflation, that economic stress then leads to calls for change and maybe we draw parallels with history, rise in populism?
Absolutely. I think what's surprising, though, in France is that Macron really did use a lot of tools available to protect consumers against inflation, including fiscal policy. I think it just seems that voters now want even more. There is a sense that we've left the QE era. Voters are clearly socially more conservative, but they want to be fiscally more liberal. And I think that is where Europe is going down, the path it's taking. It'll be interesting to see if Le Pen actually becomes part of that Europe-wide movement.
Why are we so certain this isn't 81?
Because we have the euro. This is the kind of truth, right? I mean, Germany in a way protected France in 81. It'll protect it again.
But the euro also can cause problems in as much as you lose control of other elements of your economy. And if France has a unique issue that it has to deal with, but its central bank can't respond, doesn't that leave it in a difficult place? Just very briefly.
Difficult, yes. The phrase the moron risk premium may apply. There'll be a risk premium. It's a repricing. It just might not be a crisis for the euro.
Lionel, great stuff. Love the piece. Looking forward to more. Lionel Laurent joining us from Bloomberg Opinion out of Paris. Coming up, just over 2 weeks, we've now got to go until the UK general election. Brexit figurehead Nigel Farage setting out his populist pitch, his Reform UK party. The numbers are complicated and hard to make sense of. We'll talk about the numbers. We'll talk about the details of his spending plans next. This is Bloomberg.
This election is, for our party and for me, the first important step on the road to 2029. Our aim and our ambition is to establish a bridgehead in Parliament and to become a real opposition to a Labour government.
That was the Reform Party UK leader Nigel Farage speaking at an event where his party outlined its manifesto that he called radical and outside the box. The group's pitch includes massive tax cuts, higher spending and taking a harder line on inflation. For more, let's discuss, and the wider political story in the UK as well. Bloomberg's Caroline Hepker joins us now. She's taking a break from Bloomberg Radio to come and fill us in on the detail here. Caroline, thank you. Really interesting that he made this pitch in Merthyr Tydfil in South Wales. A lot's been made of the threat that reform poses to the Conservatives, but this was trying to park his tanks in Labour's lawn, and that's what he's going after here.
Yeah, absolutely. I think he wants to be a threat to both the political parties and to be, as he puts it, the real opposition to the Labour Party. Look, this was not called a manifesto, not least according to Nigel Farage. What it was a contract with the people, and it is not short in terms of our ambition. So the Reform UK Party wants to, for example, leave the ECHR, the European Convention on Human Rights, in the first 100 days. Make those massive tax cuts to income tax and many others besides. Also increase spending. Scrap the NHS waiting list, for example. 7.5 million people. Stop the boats by returning migrants that cross the Channel over to France. The ambition is enormous. The reality is that Nigel Farage has tried 7 times to gain a seat in Parliament here in the UK and has failed every time. But he has been the architect and one of the main drivers behind Brexit, and really is returning to that theme that perhaps the things that voters have been unsatisfied with, his party can answer. In terms of the polling, the latest YouGov polling shows that Reform UK may be in line for 7 seats, but that is still just the polling.
How much of a difference does it make to the broader campaign, given that you just mentioned these large spending increases when there is no fiscal headroom? How seriously is it being taken?
It is being called problematic by the IFS, which is the widely respected think tank. I think there are significant concerns about simply the enormous spending and tax cut pledges, totalling, what, 90 billion in tax cuts, 50 billion in spending pledges. I mean, this is really a manifesto that has everything in it that would be hugely attractive, but how you pay for it is in serious doubt.
Do you think he called Liz Truss or Quanti Partey before he?
Yeah, I think this is the difficulty, isn't it? This is the difficulty, I think, for the Conservatives and actually even for the Labour Party to answer. Nigel Farage has a huge brand, and that has been present in all of his electioneering. It is very appealing to a certain section of the population, and you know, he could, in terms of...
But the markets will look at this and go, we've done this, we've told you no, why are you coming back to us again? Truss was at the right of the party, she pushed this agenda, the markets didn't accept it, we saw the guilt crisis. This feels like, to Anna's point, this is Truss plus. Is he trying to push that point even further?
Yeah, and look, they put up candidates also in the local elections, and out of the 500 seats that they vied for, they only got 6 councillors. So the reality is that Reform UK is, although it has a long history through the Brexit campaigning, it's still a very new party and it is still on the fringe. But that doesn't mean that it can't pose a problem to Rishi Sunak, who has not managed, for example, to deliver on stopping the boats and on the economic growth that the UK needs. So it is more that Nigel Farage is a charismatic figure, and he is one who, to voters, you know, is perhaps the easy answer to some of the very difficult questions that they
certainly has a history of disrupting UK politics, even when he doesn't have his hands on the exact levers of power. Let's talk about where the broader polling story takes us, though, and that is to the Labour Party. They've been making a pitch to around finance and business of late, and we continue to see these MRP polls or surveys, these really detailed seat-by-seat analysis pieces that are coming out from various pollsters, giving Labour an incredible lead in the polling.
Yeah, absolutely. And that has remained pretty steadfast. We've only got days ahead of the July 4th vote, and Labour is still very much in advance. I think the issue, though, that, for example, one of the shadow cabinet members, Wes Streeting, has pointed to is that the Labour Party is being judged as almost a party in government, when actually it's still vying for that government role, and so feels that there is some difference in terms of what the media coverage is doing for the Labour Party. But yes, the polls have stayed fairly steady, with the Labour Party simply incredibly, you know, much far ahead, 20 points ahead of the Conservatives. In terms of the seats, the issue is that the Conservatives may face a wipeout and fewer than 100 seats. That would be the first time since the Second World War, probably the worst result in a couple of centuries for the Conservatives, if that is to play out. But there is some incredulity about whether that would actually happen on the day or not, despite the sort of polls. Would it be that magnitude of wipeout or not?
All right. Bloomberg's Caroline Hepker walking us through the doomsday scenario for the Tories. We appreciate it, as always. And, of course, the political turmoil seems to be the story on, well, both sides of the Atlantic, but also both sides of the English Channel, which brings us to what's going on in the EU. Leaders have postponed a deal on how to divide the bloc's top jobs, opening the door to further bargaining before a summit next week. Oliver Crook joins us now from Berlin, watching the story very, very closely. Ollie, what's the latest on the deal?
Yeah, Kriti, we thought we might get away with a sort of big European decision that was made kind of earlier on time, and effectively we do not, right? So what they were supposed to be doing was the EU leaders, the member states, had descended into Brussels, had this very long meeting last night, late into the night, where they were really supposed to thrash out the top jobs of the EU, which is, of course, the product of the election that we just had a couple of weeks ago. Now, there has been sort of broad consensus on a number of the figures, namely Ursula Von Der Leyen, but the devil comes in the details. Have a listen to what Mark Rutte, the Prime Minister of the Netherlands, had to say.
I think she's an excellent candidate for a next term as Commission President. Obviously, there is also a question of the whole package. That's why tonight I do not expect. Formally, we cannot decide, but also I think in an informal meeting there will be more consensus, is my expectation. So the formal decision next week.
So for the top job, Ursula von der Leyen, President of the Commission, that seems all but assured. There are some questions, though, on especially the European Council job. Now, that is the job that is currently held by Charles Michel. That is effectively the function of the shepherd of all the member states, of all the leaders in Brussels, making big decisions like the one that was supposed to be made last night. And what the EPP wants to do is to break that into a 2 terms rather than the 1 5-year term, split in half. That would give the EPP reign over 1 1/2 of the term and the Socialists on the other. So that's where the bickering seems to be going. That is then kicks it into next week's meeting, where you have the EU informal leaders meeting. And of course, that meeting will wrap up just 2 days before the French election, which obviously looms large over every single conversation in Brussels.
Yeah, so how is it affecting the story in Brussels, and why is Macron struggling to get his spending story across at home? I'm just kind of wondering how those 2 factors are interacting. If you were to see the left or the right winning in the parliamentary elections in France, how would that ripple back their spending plans, also ripple back into the spending plans of Brussels?
Well, of course, there's a huge question of how that government will actually function, right? The interesting thing is that whoever wins it and whoever gets the prime minister sort of has the power of the purse, which is the power of basically a lot of things, right? Macron would remain the sort of president. Huge implications, of course, also for defense. Macron been very outspoken. But again, Guy, what we really don't know is in terms of these sort of the platforms for both this sort of new left coalition. I mean, these are not parties that necessarily see eye to eye on a number of issues. Where is the sort of policy weighting going to be, the priorities within that? You know, Jean-Luc Mélenchon, for example, is very different from, say, the sort of center socialists. And of course, Le Pen, their sort of policy seems to be constantly evolving. They had a sort of dossier up on their website that was taken down last week, in which it was all about European defense, saying that France basically should be pulled out of the NATO command structure. So all of this policy stuff is still very much in the air, though the power of the purse does reside within the prime ministers.
Oliver, it won't have escaped people's attention in France that the French football team was playing yesterday. I know you'll be doing all you can to try and unite these stories for us. European politics and European football very much to the fore. I saw this in the England context, or the wider UK context, at least Scotland and England in the Championship. I saw this being talked about in the context of people being more familiar with political news, because more people are watching TV right now. They're all watching the football, and by accident they might pick up lines around politics. I mean, we hope for a little more from our Bloomberg audience. But how do you bring these 2 stories together for us?
Yeah, well, listen, I will tell you that despite all the political move, the one thing that is totally ubiquitous here in Germany, where the cup is being held, is soccer, or the football, right? This is like in the office, we have it here. You walk down the street in Berlin, the game is going on. You can basically watch the game uninterrupted walking through the streets of Berlin, because it's up everywhere. Where it's interesting is that obviously, you know, some analogies have been made by certain people, maybe Guy Johnson, about the sort of bloodied nose Mbappe and Macron, you know, maybe being able to sit out the rest of the season. But this is also serious stuff in France. I mean, Mbappe gave a press conference yesterday in which he said that he is against extremism, against ideas that divide, and that they have an opportunity in France to choose the future of the country, and that they need to emphasize the importance of that task. So really no part of the soccer even is being able to escape the politics within France right now.
We should probably just explain. The shot we just showed you is of the Brandenburg Gate. There's a huge football goal on the other side of it. If you watch any of the football coverage, yeah, it's huge. Just you can see, even I could score in that goal. And just in front of that's where a lot of the TV pundits are sitting as they analyse the games. It's a lovely shot in the evening. I was watching Gary Lineker sitting up there the other night, enjoying the debrief after the England game. Anyway, that seems to be the epicentre of the football story in Berlin.
Oliver, thank you.
Just to explain.
Bloomberg's Oliver Crick joining us there from Berlin, immersed in the politics and immersed in the football for us.
He did. Coming up on the program, another thing that Oliver has been pointing out and covering very aggressively is what's going on between Russia and Ukraine. Russian President Vladimir Putin now heading to North Korea for the first time since 2000 as he faces renewed challenges in his war on Ukraine. We're getting more on that story next. This is Bloomberg.
44 minutes into the equity market session this Tuesday, the 18th of June. We've gapped higher first thing this morning. We seem to be holding that gap right now. We're up. We're not up significantly. We're basically pricing in what we saw out of the United States yesterday. The US pushing on the S&P up to its 30th record high for the year. And that is basically the picture that we've got holding in this morning. We're looking for another catalyst. The ZEW is going to be coming out a little bit later on. We've got retail sales out a little bit later on. Not entirely sure that maybe retail sales are big enough to kind of move the dial.
I was trying hard to get excited about them, so delve deep into the Bloomberg Economics research, which has served a purpose. So retail sales increasing more slowly than usual is one of the things they're going with. And if you look back at all of the sort of periods of increase in retail sales in the past, this is sort of in the lowest quartile. This is not impressing in that sense.
Yeah. So do you have higher wages, so real wages not only catching up, which have caught up, but are they going to continue to rise? Is that a concern to the Federal Reserve? But also, this is a story that goes global, right? It's not just a question of you make more money, you spend more money. This is something that around the world you're seeing. I was reading a story this morning about Germany's labor strikes, and immediately I got, or labor negotiations, I should say, and I immediately got deja vu from the UAW, Hollywood, pilot flight negotiations, the conversations between Toyota in Japan with its folks.
But those were all the kind of the peak of the inflation kind of picture, weren't they? It feels like the inflation story is fading a little bit here at the moment. So that's the surprise to me about what IG Metall is doing here, is that inflation is coming down, yet they're still pushing for this very aggressive. Yeah. They still feel that there's more to be extracted.
And we're going to hear from a lot of ECB speakers today as well, which I think is interesting. We heard from Philip Lane yesterday, and I think if there's chances to ask questions of any of them, the questions often will be around France. Sure, it'll be about the broader wage story and the inflation dynamics, but around France and what that means, because Philip Lane saying yesterday that we're seeing a repricing there, not disorderly market dynamics. And that was an interesting part of our conversation earlier with various sort of bond market guests saying, yeah, that's true. We're not this isn't dysfunctional, but we're still waiting to see what happens.
And isn't this the theme, though, that we're seeing, that even though the data suggests one thing, and we can see it as financial presenters or even economists, investors, et cetera, but then if you talk to someone on the ground, whether it's in the States, whether it's in Germany, whether it's in another part of the world, they may not be feeling that economic strength as well as the consumer sentiment data out of the States last week that I think is quite representative of that dynamic. But let's zero into the Germany story here. Germany's largest labor union is what we were discussing, seeking a wage increase for almost 4 million workers in the metal and electric parts industries. There is a broader macro read-through. Let's bring in Bloomberg Zero Area Economy reporter Alexander Weber to break this down for us. Alex, walk us through the read-through in terms of an ECB that is still trying to get wages lower.
Yeah, for the ECB, I mean, this is probably a sign that inflation pressures and wage pressures are not just dissolving into thin air. So the IG Metall is seeking 7%. That's barely lower than what they pushed for 2 years ago when inflation was approaching more than 10%. And this deal often is used as a blueprint for other parts of the economy, so it's very important. What the ECB needs to see is a slowdown. Wages grew about 5% in the first quarter. That's not in line with the 2% inflation target. A rule of thumb is that 3% is probably in line with that goal. So 7% would, of course, be much too high. But another rule of thumb is that the unions typically get half of what they push for. So even that would be a little bit above what the ECB needs in the longer term. But the question is whether that old rule of thumb still holds true in an age of labor shortages and so on.
Yes, and so, Alex, what are the labour unions' chances of succeeding here? You suggest that maybe they have to settle for something half as good as they'd asked for, but businesses at the moment, I think, are holding firm with and offering very little.
Yeah, so it's probably going to be a tough negotiation round. It's going to start in the fall. So labor unions have really found new confidence in this whole inflation episode because we've seen a lot of shortages, especially of skilled staff in Germany's manufacturing sector, which is where these negotiations are happening. So there's a good chance that labor unions will not settle for what they used in the past. At the same time, manufacturing in Germany is still kind of reeling from the loss of competitiveness, higher energy costs, and one employers' association already said there should be no raise at all, which the labor union immediately dismissed as disrespectful. So it's going to be a tough round and one that the ECB will surely watch very closely.
Let's just talk about what is happening in the rest of Europe. How isolated is Germany? How different does Germany feel in terms of the wage story, the wage picture that we're seeing elsewhere?
So the specialty when you have to decipher Eurozone wages is that it works very differently in each country. So in Germany, it's a much more staggered process than elsewhere. Typically, wages reset at the beginning of the year, which is why the ECB has for a long time said we need to see what's happening in the first quarter of this year, and that has given officials some confidence that there is a slowdown baked into these deals.
Yeah.
So more recently, Philip Lane has been going around saying that he's getting more confident that wage pressures are easing, because next year there's going to be a lot of growth in the area of 3%, not the 5% we've seen at the beginning of the year.
Yeah. Which is consistent.
But then,
with,
you know, which is
probably consistent with price stability. Yeah. Alexander, great stuff. Thank you very much indeed. Alexander Weber joining us out of Frankfurt. Let's talk about a different subject. I want to draw your attention to what is happening in North Korea. Now, that's not a sort of way I start a sentence very often, but this is significant. The Russian President, Vladimir Putin, is on his way to North Korea. He's also going to be going to Vietnam as well. These are red trips, and they have become a little bit more frequent. These are relationships that are getting sort of tighter and tighter. Clearly, Putin faces renewed challenges in his war in Ukraine. Some of that is simply about how quickly he can rearm his troops and where he can get shells and advanced weaponry from. Potentially, some of that now coming from North Korea. Some of it is coming from North Korea. John Herskovich joins us to talk about this. John, we spent a lot of time on this programme talking about how Europe is rearming. We spent a lot of time talking about how Europe is sending a lot of weaponry to Ukraine to make sure that it can defend itself against Russia. Can I think of what is happening here with Vladimir Putin's trip to North Korea as kind of the sort of symmetrical opposite of what we're seeing here? Is this basically a shopping trip to try and get his hands on fresh weaponry?
Well, he's actually gotten quite a lot of weaponry from North Korea already. We spoke with South Korea's defense minister last week, who said that shipping containers sent to Russia, there have been about 10,000 of these, and these could hold about 4.8 million artillery shells, the types that Russia's using on the front lines against Ukraine. Now, just as a comparison, the EU is struggling to meet a commitment of 1 million shells for the current year. So North Korea is sending huge amounts of armaments to Russia. The two share a border. They're very close on the eastern side in terms of ports, and the cooperation is quite tight. And North Korea possesses huge amounts of munitions that are interoperable with Soviet-era systems that are on the front lines. It has parts for old tanks, it has shells for artillery, it has artillery rockets, and Kim Jong-un is trying to shop even more stuff over to Russia, doing tests of new weapon systems, that some of which he may try to show to Putin during his visit.
I mean, this is obviously something that's going to be catching the attention of a lot of the partners of the United States, of course, a lot of Western Europe as well. What kind of reaction are we expecting, if any, at all?
We're going to see denunciations of this. There's going to be a call for tightening of sanctions, but there really isn't all that much that the West can do to stop this. The two countries share the border. They can do shipments between the two ports, between ports on their east side, and keep these within coastal waters. There's very little that can be done in terms of interdiction. So, and the trade is set to continue and grow even more. And they're doing this in view of spy satellites and commercial satellites. Bloomberg's published image of North Korean cargo ships in port in North Korea. So it's there. The U.S. has provided images of Russian ships in North Korea going to Russian ports, and then the munitions being taken by train across Russia to the front lines, to munitions dumps near the border with Ukraine. It's all been seen, but it hasn't been stopped.
John, thank you very much. Thanks for the update. To Bloomberg's John Herskovits with the details of President Vladimir Putin's trip east and what he is looking to achieve with that. Guy, we've got a few data points to look ahead to. So away from the geopolitics, there are a few things to watch out for. We talked about retail sales out of the US. We also get the ZEW out of Germany and that important survey of economists and analysts. We're expecting improvement, I think. That's coming very shortly, in around an hour's time, in fact. We are expecting improvement in some of that data out of Germany.
It is.
Can't all be the football.
No, we can try. we can do our level best to take everything in that direction. But yeah, so the data has been improving. And we were talking about this earlier when we were talking about what TKO was kind of referencing in terms of their belief that Europe is actually going to be improving from here. Some of this data is showing up, but it feels very gradual at the moment in terms of the improvement that you're seeing.
But the argument that TKO was making when he was giving those examples was talking about a lot of that fiscal spend. They're saying we're expanding our sectors. That at its core requires, I'm just providing kind of the devil's advocate point of view here, that at core requires a lot of fiscal spend, which is the core of the issue right now in France, in the UK, arguably in Germany as well, that you can't actually fund these things even though it's fairly ambitious.
And so his big question, how orthodox will the fiscal plans of the National Rally, of the far left in France, how orthodox will those look? And the market, in his view, is not pricing in a step up in fiscal spend yet. We've sort of sold off French debt, OATs, on uncertainty, but not necessarily because we've priced in a whole new expectation around fiscal spend.
What I still love is the fact that the US spends a load of money and the economy takes off and everybody loves it. Europe talks about trying to spend a little bit more money and everybody gets freaked out.
The definition of a reserve currency and
exceptionalism. It just continues to be something that I think is entertaining to watch. Sonali Basek's got a great conversation coming up a little bit later on. You definitely want to tune into this. She is going to be speaking with Citigroup's CFO, Mark Mason. That is going to be an interesting conversation. There's a lot being made of what is happening within that bank and how Jane Fraser's turning it around right now. It was interesting to see people highlighting actually some areas of the bank that the market hasn't really noticed yet.
Yeah.
And maybe that's something we're going to be seeing coming out of that conversation. That's one of the big conversations that are going to be happening here on Bloomberg a little bit later on. We do have retail sales. We'll be going to be analysing those numbers for you. What is happening next? What is happening next is the Pulse. Look forward to continuing market coverage. That's it from Anna, Kriti and me. This is Bloomberg.